Hello everybody, welcome to the 7th video on me learning how to trade using Forex. So in the last video we covered what are commodities, basically explaining what commodities are, and in this video we're going through the trading commodities in the Introduction to Financial Markets lesson or course in the Forex official forex.com. So yeah, let's get started. So trading commodities. Trading oil, gold, or silver doesn't require unloading and offloading huge amounts of physical assets. Let's take a look at how futures and options exchanges enable commodity trading on a global scale. How are commodities traded? When commodity consumers want to purchase goods for immediate delivery, they'll take to the spot market. Here, the buyer can expect delivery of their chosen asset as soon as their trade is settled. When you see a live price for a commodity listed, it will often be the spot price. However, most speculators don't want to take immediate delivery of the commodity they're trading. It would require a level of infrastructure that most traders don't have. So instead, they use derivatives called futures and options to buy and sell gold, oil, and more without ever seeing any physical assets. Futures enable you to trade a contract today in which you commit to buying or selling a set amount of commodity for a set price on a set day in the future. So, commodities. Commodities. So are traded through future and option through futures and options exchange. Future enables you to trade a contract today in which you commit to buying or selling a set amount of commodity for a set price on a set day in the future. So enables to trade a contract today in which you commit to buy. Enables you to trade a contract today in which you commit to buying a set amount, to buying or selling a set amount of a commodity at for a set price on a set day, or a set price on a set day in the future. And an option gives you the right to buy or sell a set amount of a commodity for a set price before the contract expires. Gives you the right to buy or sell a set amount of commodity for a set price before the contract expires. So the future one is basically, it's like you do it on a set day, so it's already like decided, whereas an option is basically like a deadline where you're allowed to buy or sell a certain amount for a set price before the deadline expires. So the right to buy/sell a set amount of a commodity for a set price before the contract deadline, before the contract expires. The prices of future and options will move up or down as the spot price of the market moves up or down. The prices of future and options will move up or down depending on the spot price, depending on the spot price. So spot prices are, I should list out what spot price means. They'll take to the spot market. Ah, right, okay, so commodities can be like bought immediately, bought for immediate delivery via the spot market. However, traders don't have the facilities for immediate delivery. Therefore, commodities are traded through. There we go. Spot price. This enables commodity speculators to use them, and speculators are people who aim to use the volatility in commodity prices to make a profit. So to use them to go long or short on assets without ever running to risk of taking delivery. Instead, they trade the future option before it expires. The prices of futures and options will move up and down, or up or down, as the spot price of the market moves up or down. This enables commodities to use them to go long and short on assets without ever running. Instead, they trade future before it expires. So go long equals buy, go short equals sell. Gold future example. So future is the one where it's set about commodity at a set price on a set date, isn't it? On a set date in the future, yep. You trade a gold future today when gold is trading at that. In doing so, you commit to buying 10 troy ounces of gold at that in 3 months. You trade gold when gold is trading at that. In doing so, you commit to buying 10 troys of ounces of gold at that in 3 months. So you trade gold future today's gold per tray ounce. Your future commits you to buy 10 ounces of that. So we're just also we're hoping that in 3 months' time it will be above 1,900 in order to make a profit then here. As your future nears expiry, gold prices to that, your future now enables you to buy 10 ounces of gold for 50 less than saving 500. Saving 500? But because you don't want to trade any actual gold, you sell your future to somebody else for 450, earning you a 450 profit. Your future is near expiry. Gold's price has risen to per tray ounce. Your future enables you to buy at that instead, saving you Oh, it's per ounce. All right, okay, so per ounce. Right. But you don't want to buy physical gold, so you sell your futures for your profit is £450. Right, okay. However, future and option prices are only driven by the underlying price of a commodity. They will also take any potential risk and charges that may arise between now and the future expiry into account. This is called forward pricing. Price are only driven by the underlying price of a commodity. They will also take any potential risk. Forward pricing. Did you know with Forex.com you can speculate on commodity spot markets without your trade expiring? We call these markets non-expiring commodities. Producers and futures. Speculators aren't alone benefiting from future contracts. Producers use them to guarantee an income from the commodity they grow or extract. An oil company, for example, can use futures to mitigate against risk of future oil price volatility. Investors also use futures to diversify their portfolio and hedge against negative market moves without having to store large amounts of bullion, oil or other assets. Where are commodities traded? Like shares, commodity, futures and options are traded on specialized exchanges. Different exchanges around the world will tend to focus on different groups of commodities. A few important ones to know are Chicago Board of Trade. Commodities that trade on Chicago Board of Trade include gold, corn, silver, wheat and rice. It is the world's oldest commodities exchange. Chicago Mercantile Exchange. The CME focuses on agricultural commodities including milk, cattle, pork bellies and lean hogs. NYMEX, the New York Mercantile Exchange, is known for being the most liquid marketplace for the trading of West Texas Intermediate oil futures, as well as a hub for trading energies and some metals. London Metals Exchange. The LME specializes in industrial metals that do not contain iron, known as non-ferrous metals. These include aluminium, copper and lead. LIFI. The London International Finance Futures and Options Exchange focuses on agricultural commodities such as coffee, sugar and wheat. Yeah, I think we read that. Commodity exchanges will only allow permitted professionals to buy and sell contracts on the trading floor, so individual traders will buy and sell futures and options via a broker. Commodities and leverage. Commodity futures trade in set sizes, depending on the market being traded. A single crude oil future covers 1,000 barrels, for example, while a gold contract covers 100 troy ounces. That makes most commodity trades fairly large as a minimum. If WTI is trading at $50 per barrel, for example, then buying a single future contract is equivalent of trading $50,000 worth of oil. Some brokers will offer mini contracts, but these still involve trading a sizable amount of each commodity. So, commodities, future trades in set sizes, depending on the market being traded. Therefore, could lead to expensive trades. To avoid tying up $50,000 each time they want to open a position, most retail commodity traders use leverage. Leverage in commodities works just like in Forex. You put down a deposit in order to control a much larger amount of capital. Instead of using a commodity broker, some individual traders speculate on the futures and spot prices of commodities using derivatives such as CFDs. We'll go into CFDs in more detail in the Trading with Leverage course. What drives commodity markets? Commodity markets can be influenced by a range of factors, and each market will have its individual factors affecting supply and demand. However, a few common things to watch out for include factors which influence the commodities market include supply interruptions, fluctuations in demand, general economic slowdowns. Supply interruptions. The supply lines of lots of commodities can be fragile and uncertain. Crops can fail, miners can strike, and oil-producing countries can see geopolitical instability that threatens supply. If a commodity becomes scarce but demand remains high, its price will rise. Supply lines of commodities can be fragile. Crops can fail. Miners can go on strike. If a commodity becomes scarce, but the demand remains the same, its prices will rise. Fluctuations in demand. Seasons can often bring changes in demand for commodities. For example, from consumers of heating oil and natural gas in the winter, gold on the other hand tends to become more popular during periods of political uncertainty. Why does gold become more popular during periods of political uncertainty? Seasons can bring changes to commodities. Gold tends to become more popular during periods of political uncertainty. Why does gold become more popular during periods of uncertainty? Damn, there's like science papers written on this. Science journals, I mean. What drives prices of gold? Because of its enduring value. Interesting. Very interesting. So, it's just like safe, basically. Yeah, it's just like a safe currency to invest in, or a commodity to invest in. Right, okay. Evidence from geopolitical risk. General economic slowdowns. Despite attempts to move away from it. The global economy is still built on oil, and if output slows and demand for oil will drop. Many metals too can suffer when industry productivity drops. So commodities can suffer if industry productivity as if productivity drops, then demand might also drop. Right, okay, so test your knowledge. Which of these exchanges would you use to trade West Texas? You would do NYMEX. If a contract stipulates up by 100 trade for 30 on, is it a... Well, what day is it today though? If a contract up by... Oh no, but then you're buying a set amount for set price on a set date. That's a future. A major oil producing nation suffers a natural disaster that threatens global supply. What might happen to oil supply? Go up because the supply decreases, but demand still is kept the same or increases. So, yeah. Cool, I think this is all done, this whole course. Let me see, overview. Let's go see all courses. Beginner. We've done the introduction to financial markets, trading commodities. Finished that. Right, let's carry on with the next one, how to trade. So start course. Right, okay, so how to trade. Begin buying and selling. Right, okay, what is this one? Introduction to financial markets. Let's make a new row. Layout is the cells below. Markets. How to trade. Date accessed 07/01/2024. Buying and selling. Buying and selling is trading at its most fundamental. Buying and selling is trading at its most fundamental. It determines your profit and the price of an asset at any given time. As we covered in the Introduction to Financial Markets course, the number of buyers or bulls versus the number of sellers or bears in a market at a given time will directly impact this price. Hence, or aka demand and supply. If lots of people are trying to sell an asset, then supply will outstrip the demand and its prices will fall. If most traders are trying to buy on your hand, demand exceeds supply and its prices will rise. Yeah. But buying and selling isn't just how prices are set, it's also an essential part of everyday dealing. Buying and selling and trading. The fundamental principle behind any trade is to make a profit, true, which is determined by the difference between your opening and closing price. Profit equals difference between opening and closing price. Let's say you decide to buy the FTSE 100 and it's at 6,000. you close your trade by selling the FTSE 100. You'll close your trade by selling the FTSE 100. So in order to make a profit, you will need to sell the index above 6,000. If you close when the FTSE is at 6,100, then the market has moved 100 points in your favour. If you close when the index is at 5,900, it has moved 100 points against you. Let's say you have a position worth £1 for every point that the FTSE moves. Buying at 6,000, selling at 6,100 makes you £100. Buying at 6,000, selling at 5,900 loses you £100. Bid and ask prices. Whenever you view a financial market, you'll see two prices listed. The price on the left is the bid and the price on the right is the ask, sometimes referred to as the offer. When viewing financial markets, two prices are listed. Left price is bid, right price is ask, sometimes referred to as the offer. When you sell, you trade at the bid. When selling, trade at the bid. When buying, trade at the ask. When you sell, you trade at the bid, which is the left, and when you buy, you trade at the ask. So buy is the right. I can think of that as bye-bye, using my right hand to wave bye-bye, so buying is my right hand, buy, so it's the right side, so you can buy using the right side, okay. When you buy, you trade at the ask. Right, okay. The bid will always be lower than the current market prices, while the offer will always be higher. Because it's like the broker's got to make a profit, so they always like make it go higher or lower than the actual market prices, so they can have that margin as the profit. What is a spread? The spread is the difference between the bid and the ask prices. Spread equals difference between bid and ask prices. That is an important thing to do when calculating profit or loss from a trade. Let's return to our example above. When the FTSE is at 6,000, it might have a bid of 5,999 and have an ask of 6,001. So to buy the FTSE, you would open at 6,001. You would need the FTSE's bid price to move above 6,001 before you can earn any profit from your trade. If the FTSE moves up to 6,002, but its bid is 6,000, then you would still make a £1,001 loss. Bid price might have a bid of that and ask of that. Wait, so you might have a bid of that and ask of that. Ask is when you buy, so you have to buy it at 6,001. And then sell it, you would need, oh right, okay, I see. But its bid is 6,000. Then you would still need, so you would need to make it 6,003 and that to 6,001 in order to break even, then basically make a £1 loss. Test your knowledge. USD has a bid of that and an ask of that. So bid is a price which you sell, so when you buy you trade the ask, buy you trade the ask. So you buy at that. If you want to buy, do you trade at 4.3. You buy the Germany 40 when it has a bid of that and an offer of that. Then you sell at, so this you sell it, you bid of that and an offer of that. Bid, so you buy it at this price. No, bid is a sell price, isn't it? Bid is a sell price. When you buy at the ask, offer of that. So you bought it at that, then you sell it. What is your point? What is your profit in points? Then you sell it. And this is when you sell, you trade at the bid. And bid is on the left hand side. So what's 99 minus 17? That's 82. Okay. Cool. Guide to short selling. Traditionally, investors could only profit from markets that went up in value, but that is no longer the case. What is short selling? Short selling is opening a trade that earns a profit where your market falls in price. Short selling. Short selling is opening a trade that earns a profit when your market falls in price. Most people think of trading as buying low and selling high. Whilst that's a great way to earn profit, it isn't the only one. It's also perfectly possible to sell high and buy low. Buy low and sell high. Sell high and buy low. Is that not the same? Sell high, buy low. To open a sell position, you trade at the bid price instead of the ask price. So bid price is the sell price, isn't it? Because ask is on the right hand side, and right hand side is buy price. Bid price is the sell price. To open a sell position, you trade at the bid price. Instead of the ask. So you're selling instead, which is a sell position, yeah. Then when it's time to close, you buy at the ask. It is exactly the opposite of going long. You buy at the ask. We covered how to short currencies in the trading Forex session lesson, but shorting is limited to foreign currency. You can sell almost any market that can buy. Let's take a look at short selling shares to see how. Sell high, buy low. Short selling shares. When you short sell shares of a broker, you're selling stocks to open your position. To get around the fact that you don't own these shares in the first place, your broker will lend you the shares and sell them on your behalf. You'll then get the proceeds credited to your account. When you close your trade, your broker will use the cash in your account to buy the shares once more. If they are worth less than when you sold them, you will be able to keep the difference as a profit. Right, I see. Sounds confusing or becomes much clearer in an example. I see selling ExxonMobil. 1. You borrow 50 ExxonMobil shares. 2. You sell the 50 for that much. 3. ExxonMobil falls to that. 4. You buy the 50 for that. You return the shares to broker and pocket the $130 difference. You tell broker to sell 50 at that. You don't own these shares, your broker lends them to yourself, so maybe half. They then credit your account and proceeds to sell, which is that. X and stock falls to that, and you close your trade. To close position, your broker buys 50 shares of that using cash in your account, leaving 100. Okay. If ExxonMobil stock has risen instead of falling, you would have incurred a loss. It's also worth noting that your total profit will be less than that once commission and borrowing costs are taken into account. Short selling with derivatives. It can be tricky to find a broker that offers short selling to individual traders. However, you don't have to short sell using this method. Derivatives such as CFDs, where you would never own the asset you're trading. So CFDs equals derivatives in which you never own the asset you're trading. Enables you to go long or short without borrowing stocks. Plus, with CFDs, you aren't limited to shorting shares. You can sell any CFD market that you can buy, including Forex, commodities, indices, and more. Opening a short CFD position is the opposite of opening a long one. You decide how many CFDs you want to sell and trade at the bid price. Trade at the bid price. Then when you want to close, you buy the same number of CFDs at the ask. You decide how many CFDs you want to sell and trade at the bid price. Then when you want to close, you buy the same number of CFDs at the ask. Hedging with a short trade. One popular reason to go short is, as mentioned, as means of hedging. So short, the open trade that earns a profit when your market falls in price. One popular reason to go short is as a means of hedging. One reason to go short is as a means of hedging. And hedging in the last episode or video we saw was where you keep something to mitigate against the risks of losing trades, losing your other trades. That's what hedging means, isn't it? To protect against market crashes, yeah. Hedging is against negative market moves. When you hedge with a short trade, you open a position that earns a profit if an existing long trade incurs a loss. Say you own several Dow Jones stocks in an investment portfolio but are worried about an impending bear run among US blue chip shares. So you sell 5 Wall Street CFDs. If US shares do fall, then your share losses may be partially offset by the profits from your CFD. Offset falling price with a short-term trade. If you extend, you maybe buy the profits from your CFD. Risks of shorting. When you buy most financial markets, you know precisely what your maximum loss could be. Invest 5,000 in gold, for instance, and your biggest risk is that the gold becomes worthless overnight and you lose your 5,000. When selling, though, there is no limit to how much a market can rise. If you short a stock before the business takes off, your losses are potentially infinite. Jesus. When selling, though, there is no limit how much market can rise. If you short a stock before the business takes off, your loss could be potentially infinite. Oof. When buying, difference between buying and shorting. Buying knows exact how when you buy, you know exactly how much loss can occur. When you sell, you don't know how much the market, how much the stock can rise. Therefore, the losses are potentially infinite. Imagine that you short the shares of a company that has been struggling with a share price of 50p. The best case scenario is that the company's share price falls to zero. However, say if news then breaks that another company is interested in buying it, its price could climb well beyond 100 pence in a day. This means that using risk management tools such as stops and limits is crucial when going short. So the use of risk management tools is crucial, such as stops and limits is crucial when going short. We'll cover these in more detail later in this course. Shorting may also come with additional costs to cover the capital that your broker is lending you to open the trade. May also come with additional costs to cover the capital of your broker lending you. Cover the capital of your broker lending you to open the trade. Test your knowledge. AUD/USD has a bid of that and an ask of that. So ask is on the right side, so buy price of that and the sell price of that. If you want to sell, do you trade at that? You sell a US oil 50 when it has a bid of that and an offer of that. Offer is the ask price, bid is so buy price, sell price. Then you buy at buy price. Oh no, this is the buy price, sell, buy, sell. So bid, offer, ask. You bought it at that. Oh no, you sold it at that. Sell. So sell is ask or offer. Offer. So it's that. You sell it at that. Then you buy it. What is the buy price? So buy is that. What is your profit in points? 795 minus 657. What's that? What's it? 1 5 minus 7 8. Is that no? Wait. You sell it when it has a bid of that. So bid, goodbye, right hand side. So it's not a buy price, so it's offer of that. So you sold it as at that price. You sell USC oil 50 when it's a bid price of that and an offer of that. Offer is the ask price or the offer is a sell price, isn't it? Offer. Right. Ask. Oh no, selling. Left price is the selling one. Oh no. But so that, and then you buy at left. Goodbye. Buy. You buy it. That. So it should be 792 minus 657, which is 92 minus 57, that is 35, so it should be that. Okay, cool. I just need to learn to get the bids, the ask, and the buy and the sell, or yeah, the buy and the sell prices the right way around, and just get them, know which numbers to take away from which. Alright, so I think we're going to end the video here. What is CFD trading? Yeah, 46 minutes. Nice, clean. Alright, okay, so that was interesting. Next video is going to be what is CFD trading. Yeah, thank you for watching. See you next video. Goodbye.